Okay, so the author's thought process here is that momentum returns may be due to investor myopia, which would mean sort of short-sighted in making decisions. So what this may cause investors to do is to ignore the long-term fundamental um, indicators and that make up the value of the company in favor of short-term news and non-fundamental data. So what they've done first is they've looked at all the, not all of them, but a lot of countries here, and they've assessed what the level of myopia is in each country from a cultural standpoint. And then they've compared the momentum returns to see if there's some kind of correlation between how short-sighted is the culture in each of these countries, and how does that affect, or how is it related to the momentum return. So what we have here is all the countries in their study and the time periods, and it's usually from back in the 80s until more recent. And then we have the momentum returns, and this is the zero cost portfolio that's been done in other studies with the 12-month look back. And we have the T statistic for those momentum returns to see if the returns are significant. We also have the Myopia Index, which will tell us how short-sighted are these countries, or the investors in the countries, with a higher value meaning the investors are more short-sighted, and a lower value meaning they look more long-term. And then we also have the standard deviation of this myopia index. So the first interesting thing to note is that overall, the momentum returns of the zero cost portfolio there is about 0.78%, and these are per month returns. This is excess returns. So for instance, going long the past winners and going short past losers and seeing what the net profit there would be. And so that's about 0.78% per month excess returns, and a 5.8 T statistic, which is very significant, actually significant at the 1% level, probably a lot lower than that. So are the country's momentum returns related to the level of myopia? Unfortunately, they didn't really sort in any particular way, just alphabetically, so we kind of have to look through here. But we can see that the highest momentum return was Australia for about 2%. Here's a 1.54, 1.67, or 2.11 Ireland, 2.52. Anyway, so if we were going to compare these momentum returns to the myopia index, we would see that Argentina was pretty high momentum returns. It has a high myopia. Australia is pretty high myopia as well. Let's see. Greece doesn't really follow that logic, but Ireland has pretty high myopia as well as the momentum. So we can see there's somewhat of a relationship between investor myopia, or from the culture of the companies, and the momentum returns. Okay, so to dig a little deeper into this, the authors split the countries into terciles, which is into 3 different groups, and you can see those here. We have the group that's myopic. That's the one that is very short-term focused. We have the long-termist third of the countries here, and then a neutral in the middle. So basically, over each of these different time periods, they've invested in a momentum portfolio in those countries and found the average return. So buying the past winner, selling the past loser of each of the countries, and getting the average across those countries for one of the third of the portfolios. 3 different measures of myopia, which are derived from former papers, and you can see these here. And then their index is a composite of both of these measures. Anyway, what's interesting to see is the tercile that is very myopic actually ends up having much higher momentum returns than the portfolios that are long-term, you can see that they have the difference here, and it's fairly significant difference, and the t-statistic is very significant as well. So we know it's highly unlikely that this difference is zero. They've also split the periods as well, and we can see these are both pretty much historical full market cycles. We see the more recent 2002 to 2015 period had much higher momentum returns than in the 88 to 2001 period. But the momentum returns from the myopic portfolio versus the long-termist portfolio are still pretty big difference. So we could argue that countries that tend to be more myopic culturally tend to have higher momentum returns. So in turn, it's likely that myopia might be related to momentum returns. And to dig a little deeper, the authors do a regression of momentum returns at each country. And in doing so, they are controlling for other factors that have been found to influence momentum returns in other studies. So they want to see, is the myopia factor actually a significant related to momentum returns, or is it just some other factors that are coming into play? So we look first at, here we have no controls, so they aren't controlling for any other factors except the myopia factor, which we see here is the t-statistics is significant at the 1% level, and also the alpha. So we know that myopia is certainly related to momentum returns. Next we get into the behavioral model. So there's been found to be a lot of behavioral factors that affect momentum returns, and you can see each of these named up here in the description. But most notably, we see that even after adding all of these factors in here, the myopia coefficient is still very significant at the 1% level. So even when we control for all these other factors, we still see that myopia is significantly related to momentum returns. What is interesting to see here is that we have, for instance, the turnover is negatively related to momentum returns, and the size is statistically significant. So we might could say that countries with high turnover negatively affect momentum returns. Also, we see here the prior 12-month returns are highly significant, and that makes sense from a momentum perspective. Next, we've got the market development, and we see here that this regression also shows the myopia to be a significant variable. Despite controlling for a lot of other market development factors, myopia is still significant. Same goes for when we add the institutional quality and the macro model, and these are all significant at the 1% level. We see here the two asterisks. So despite controlling for a lot of different factors that have been found to be related to momentum returns in the past, we still see myopia to be significant and explaining momentum returns.